Indrani, welcome to the big conversation.
Thanks, Jamie. So glad to be here. Thanks for having me.
So this week we're talking about the shape of the yield curve, shapes we actually haven't seen for about 15 years or so. And I want to dive into what this means for us as investors, what it means for the different asset classes. But first and foremost, before we get to that, I would love to get your take on inflation here and whether we're seeing enough demand destruction to affect inflation.
Absolutely. I mean, inflation is obviously the question of our times. I will break that question into two parts because today's inflation is both a combination of excess demand and supply shortages. So the reasons if it's going to roll over or not come from both sides. So quickly on the supply side, obviously the disruptions happened post-COVID and more so after the situation in Ukraine. Now on that front, we are seeing some improvement, meaning it's not just oil prices that have come down, but our broad CRB commodity indices, they are down about 12% month to date. Your shipping rates have come down. And, the New York Fed actually runs a global supply chain pressure index, which has also come down. So there are hopeful signs on the supply side, not perfect at all, but better than where they were maybe a month and a half back. Now, coming to the demand side, which obviously Federal Reserve Bank and all central banks control, that is their number one priority. At any cost, they have to control inflation is their message to the market. And you're seeing that the expected rate hikes end of July will take us to the neutral rate. And the Fed has indicated they'll go on to the restrictive rate territory. Now, that is priced in by what the markets are saying in terms of where does the Fed fund futures curve peak and roll over, which accordingly means when are they pricing in a recession and rate cut. Now, that expectation of recession, where we started at the start of this year and when we are now, it's really gotten pulled in. Right now, markets are pricing that, by end of this year, we will be in a recession. Early 2023, the Fed will, possibly start cutting rate. So this is on the actual inflation demand supply indicator side. I do want to quickly touch upon the inflation expectations because that's very important to the Fed. And expectations from the financial markets, and you see the market expectations of inflation, that has come down quite a bit in June. And even the consumer survey that University of Michigan runs, the longer end inflation expectations have come down. So one would think that by all these indicators, market is expecting that the Fed will be successful. And maybe by end of this year, we will see a much better picture of inflation than where we are now.
Indrani, you make a great point there, actually, to monitor not just inflation, but inflation expectations. Now, secondly, let's talk about the shape of the yield curve now and what it means for us as investors and what it means for asset classes.
That's a very interesting point because the sovereign yield curve is really the foundational asset class for everything that happens in the financial markets. And again, instead of just watching individual points on the curve, we like to watch it more on averages, meaning like the World Government Bond Index that we have at the 7 to 10 year duration and at the short end 1 to 3 year duration, and the difference being the slope. So obviously the slope has distinctly flattened. We have gone into inversion territory. That's point number one. And the point number two is at the long end, we seem to have peaked and come down a little bit. Now, when you see these two important data points, couple of things that's important. Particularly for long horizon income oriented investors, fixed income, particularly in the longer duration investment grade, may now be providing enough income to become a much more viable asset class than it had been in recent years. Second thing that's very important is we remain and will probably continue to remain in a period of high economic uncertainty. When in that environment, volatility remains high. So one might be interested in positioning for lower volatility side of the asset classes. Then commodity prices, while they have come off their peak somewhat, but again, commodities run in long cycles. So chances are that we could be having commodity prices that remain higher than what we are used to over the last 5 to 10 years. And this whole rate curve also has implications for equity markets, particularly on the factors front, value relative to growth. And we have seen the value outperformance year to date for similar reasons.
Well, if you don't mind, let's stick on that topic. Now, I'm not asking you to call equity markets per se, but we've had growth outperform value for such a long time. And now that trade has flipped, do you expect growth to outperform value for the next several years?
You touched upon a core point that I would have raised, that essentially on this whole value growth spectrum, these tend to follow long cycles. Now, coming again to addressing the question in terms of the drivers, where we are right now, if rates are high, then the discount factor for your growth companies, the discount factor is more, that makes growth comparatively less attractive. Similarly, it's not just higher rates, it's also the fact that we are in a quantitative tightening period. Liquidity is getting drained out. And in that situation, when valuations get compressed, again, the growth companies get hit more. And we had recently talked about the high economic uncertainty. Now, when you are in a period of higher economic uncertainty, cash flows and earnings that are far out into the future, they become more risky. So these are all triggers that make value relatively more attractive in this particular cycle. And I do want to address that because these are long cycle things. The mathematical concept of distribution, there is always mean reversion that kicks in at a certain point. So the things that we talked about, think of them like the triggers. But by the concept of mean reversion, if we had 10 years plus of growth outperforming, there are higher chances that we will be in for a period when value outperforms. And we have seen that year to date, specifically in the US in the Russell 1000 space. If you look at the Russell 1000 value and the Russell 1000 growth, year to date, while both are in negative territory, but the Russell 1000 value has outperformed its growth counterpart by close to 13 percentage points, which is fairly significant.
Well, Indrani, it's great to have you back on the show. Thank you so much for joining us again.